the rating in which the available funding out of allocated gold on the liability side is zero. In other words, you cannot use a position whereby you owe other people, whether it's banks or individuals, unallocated gold. You cannot use that to fund anything on the asset side of your balance sheet. On the asset side of your balance sheet, if you have an unallocated gold position, that gets a haircut of 15%. In other words, that's valued at only 85%. Now, this goes into a calculation where it must always be 100%. So what this basically means is that a bullion bank operating in the unallocated gold market, and the London market is totally unallocated. Don't confuse it at all with an allocated position. We're talking just totally unallocated. Unallocated is created out of bank credit. The creation of bank credit is used to create an unallocated position. So we're only talking about that. But so banks will not be able to offset, say, an unallocated liability with an unallocated asset. So you can see that when it comes to running a book, they can't do that. They can't offset one against the other anymore. And not only that, but there are huge financial penalties involved in running an uneven book. So what this basically means is that, first of all, you've got the European banks pulling out of the market at the end of June, and then you're going to have every other bank in London pulling out of the market by the 1st of January. It is possible it might be extended, but that goes against the spirit and the whole rationale of the thing. And I do know that this has been discussed, if you like, secretly, if you like, between interested parties for a considerable time. And I can tell you that the Bank of International Settlements, my information is that they are not going to backtrack on this. So this is about as firm as you can get, and you can understand why if you really examine the reasons behind it. Now, not only do we see London effectively closing down, the end of that market, and we're looking at a market which is 9 times the size of COMEX, of the COMEX gold contract, 9 times the size. COMEX is where these people hedge their positions in London. And increasingly, what they have been doing is playing the game of, sort of fleecing the idiot money basically being hedge funds. And they have been doing this extremely profitably for some considerable time. But given that the bullion bank trading desks in London are going to close down, these are the same people running trading desks on COMEX, what is known as the swaps category. The swaps are no longer going to exist. I mean, there may be some which aren't European, some which are not LBMA members. I wouldn't know. But I can tell you that virtually all the swap members, that category on COMEX in gold and silver contracts will not exist after January the 1st, 2022. Wow. So this is a major change in the market. Now, the implications are quite important, even from that, beyond this. The first thing is that this is happening at the worst possible time in the sense that dollars are being printed at an accelerating rate. In other words, fiat money is collapsing its purchasing power through sheer overissuance. And of course, gold is where you would naturally go to offset this. So this is not an easy time for the swaps with short positions. And the short positions on COMEX are in the order of about $24-25 billion between all of them. So that's a net figure which needs to be closed out. And it'll be closed out in the coming months. So that's very important. Also, when you look at the central banks' involvements, central banks have been leasing gold into the market for some considerable time. And there was an analyst, a highly respected analyst called Frank Veneroso, who looked at this back in at the beginning of the millennium. And in 2002, he produced a paper, which is actually shown on the Garter site, where he estimated that gold out on lease was at least 10,000 tons and could be as much as 16,000 tons. Now, that was at a time when central bank gold reserves totaled around about 24,000 or 25,000 tons. Today, it's 35,000 tons. We don't know the size of leasing in the market. It may well be less than that 10,000 tons because, of course, things have changed somewhat. But we have seen times when, for example, the Germans and the Dutch have decided to recall their gold not held by them, particularly from the Bank of New York. The Federal Bank of New York. And we could see that the Federal Bank of New York was unable to satisfy that demand, particularly in the case of Germany. So we don't know, but you can be pretty sure that there's quite a lot of gold double counted at a time when this paper market is effectively shutting down. And of course, there is the other aspect, and that is that the paper markets have been used, particularly by the Americans, to control the gold price by increasing the supply of paper to absorb demand. That has been a very important part of controlling the gold price, particularly following the failure of various auctions in the 1970s after the Bretton Woods arrangement ended. So the problem that we now have, or at least from a strategic point of view, is that if we are moving towards markets which are driven by physical, then obviously the pricing power moves from paper markets which no longer exist to China, which is by far, the Shanghai Gold Exchange is by far the largest gold exchange, physical gold exchange in the world. So there are lots and lots of implications that flow from this. One of these, which I think is very important to try and understand, is that we are having withdrawn from us paper supply, which is in the region of somewhere like $250 to $300 billion worth of paper gold is going to be withdrawn. Now, that supply goes. The question then is how much of the demand is going to then find itself, with no supply. And I think it would be wrong to say that everybody who owns an unallocated account with a bullion bank is going to automatically switch, try and buy gold, because he'll just end up with paper. But there is likely to be quite a lot of holders who think that they have got gold, exposure to gold through a bank, who find that their accounts are closed and have no gold and will want gold. Now, that is bound to drive the price substantially higher once people begin to realize the importance of this situation.